All right, how's everybody doing tonight? Let's get rolling. How is everybody doing? Welcome back to the Strategy Room. This is our weekly live stream. This is the Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be getting into a lot of stuff. I got Federal Reserve information. We're going to be looking at a bunch of stuff there. What are the ramifications of the interest rate changes that happened this week? What are the big kind of takeaways from the Federal Reserve meeting? How are things going to play out in the Treasury markets with interest rates? We're also going to look at some other stuff. Some other big news that came out this week where a number of federal agencies came out and basically gave guidance as to what they're going to do with bank mergers. So that was some big news. We're going to take a look at that. We've also got an update this week on banking as a service and basically how are things continuing to play out with that. More things going, some lawsuits flying there with the Evolve Bank and Trust. So we could just have a ton of stuff, and then we're just going to do all of the typical weekly breakdown as well. I'm going to give you guys some economic indicators. We're going to talk about some information, other economic indicators that came out this week, and we're going to get into a bunch of other banking news as well. So, but I think first, I'm just going to start off with kind of a quick rundown here of some of the episodes that came out this week. So I had the rise of Tether as I continue the crypto series. That was part 10 of the crypto series, where I just get into a great Wall Street Journal article on Tether and how Tether has really exploded, especially since basically their biggest competition, Terra USD and Luna. Basically, collapsed in 2022 and are out of the way. And so since then, they've really become big stuff there. So definitely worth checking that out. What do small businesses want from their banks? That was episode 224. So I basically looked at, different survey there about what, just information that was coming back from small business owners. What are the things that they really want their banks to be focusing on? What kind of service do they expect? What kind of digital products, other things going on there do they expect? Then we did episode 225. How can your bank improve digital lending? And this was kind of a topic that was near and dear to my heart, with kind of my background in loan automation and things going on in that area. And I thought that was a really good topic because there's a lot of great things that get brought up there. And there's some things that banks can deliver, and there's some things that they just can't because they're just because of cost, because of time, just because of difficulty. So, but that was I think it was really good. I'll call it an exercise. It was a great exercise to kind of walk through that and see, what was going on there in terms of, how banks can really work on their digital lending platforms. Then we went into episode 226, which was an update on the Basel III endgame. So basically the Basel III regulation, which was coming down, which changed, and we had kind of a compromise. I'm going to read you guys a blog post piece on this in a second, basically called, do regulators change their minds, from Bank Director, which I thought was a great kind of add-on piece to that episode. Then we did episode 227, which is the Fed's 2% inflation target a good mandate? And I specifically put that episode out on Wednesday, and it came out actually a couple hours right before the Fed made their announcement, because basically the question I asked is a path of reducing interest rates, is that the right decision? Does it make sense for us to be doing that at this time? I think there are pros and cons on both sides of that. I happen to feel right now that the cons far outweigh the pros. But like I said, but we'll get into a deeper conversation that in just a couple minutes here. We get more into the Federal Reserve stuff and decisioning and things like that. Then I did episode 228, which came out yesterday, and basically, what should bank board members be reading? I thought that was kind of a good episode, just because I've had a number of books for bank board members, and I thought it was good for, whether you're looking at joining a bank board, whether you're currently serving on a bank board, or whether you're, even a veteran who's been on a bank board for many years. I go through 8 books in there that I think are, should be basically required reading of, any board director out there. And, very, very well-rounded group of books that get into everything from, financial analysis to just, basic things of just running the board meeting, being good what does it mean to be a good board member in terms of etiquette and how you carry yourself and how you deal with other board members when you disagree on things. But then I got this. I figured I'd share this with everybody. So this is hot off the press. I just got this 2 days ago. The Ultimate Guide to Bank Directors Back to Basics. So Catherine Giglieri. She was a co-author on two of the other books that I had recommended. She's flying, I guess, solo on this book, but can't wait to kind of dig into this one and get a little bit more information on that there. But once I kind of get a little bit more info there, I'll be sure to kind of share that one with everybody. So, okay, let me read this before I do the economic indicators. I just want to read this real quick for everyone. All right, let me come back there. Okay. So this was a blog post. Again, this kind of ties back into the Basel III Endgame update that I did. And that is, do regulators change their minds? And this is a blog post from Naomi Snyder, who's an editor-in-chief at Bank Director. And she basically said a significant shift occurred this week. The Federal Reserve's Vice Chair for Supervision, Michael Barr, announced the Fed would re-propose capital rules for the largest banks, adjusting for feedback heard in the rulemaking process. The Fed, along with the Office of the Comptroller of the Currency and the Federal Deposit Insurance Corp, first proposed more stringent capital rules for the largest banks over a year ago. However, faced with industry pushback and feedback from their regulators, Barr said the agency would scrap the old proposal and come up with a new one. Under the re-proposal, globally systemic important banks would see their common Tier 1 capital requirements increase by 9%, half of the earlier proposal. Barr also said that in comparison to the prior proposal, he will recommend reducing risk weights tied to mortgages, fee income, and derivatives. Meanwhile, mid-sized banks from $100 billion to $250 billion in assets would have to count unrealized gains and losses in the securities portfolio, more on that in a minute, toward regulatory capital, resulting in an estimated 3 to 4% in additional capital required. The industry had argued that more onerous capital standards would reduce lending to borrowers of all kinds. Correct. That is absolutely correct. It would reduce the more capital the bank has to hold, the more it would reduce lending. Bart Smith, who is a presenter at Bank Director's Bank Board Training Forum, which starts with pre-conferences events tomorrow in Nashville, said regulators certainly can change their minds. Disagreements about capital can be one of the key relationship killers when it comes to banks and their regulators. He said, yes, I would absolutely agree with that. For example, finding out during an exam that regulators want more capital can be a painful and discouraging experience. Capital is more expensive than debt for banks, as Barr noted in a speech this week. Yes, it's very true. Capital is a bulwark against losses, but the more a bank retains it, the lower its profits. Smith suggested banks carefully assess their risks and articulate to regulators how they are addressing those risks to avoid disagreements over capital needs. The more you can identify your risks, he says, the more you are in control of your capital. Now, that is a very, very true statement. However, there's always a balancing act there, right? But I will also tell you this, that, when regulators have their mind set on something, if they come out and basically say, we want more capital, we demand more capital, I mean, you can go in there and you can try to explain away, hey, we've got all the risks covered, we got this, we got that, it's all good. You can try to do that all you want. It's not going to go anywhere. But I just thought that this blog post just hit on some really key things. Disagreements about capital can be one of the key relationship killers, and that's absolutely true, because you have this tug of war between, if banks hold more capital, that's less money that they can lend out, therefore it's less profit that they can make. But you need them to hold a certain amount of capital, because capital is a bulwark against losses. So it's this kind of balancing act that you have to weigh. But I think that part of the problem was the original proposal that came out on the Basel III Endgame was just way over the top, and the issues that were plaguing the industry and continue to plague the industry are basically unrealized gains on bond portfolio caused by the Fed increasing interest rates, and what kind of this new term that kind of came about, the uninsured deposits. And neither of those things, that like capital was not really necessarily the main issue. The banks have been very well capitalized for the last 10 years or so. Hasn't really been a big issue there with that. So I think that they proposed something that was over the top and didn't really make sense to begin with, and they got a lot of pushback on it. And so they decided to come back and say, okay, we'll compromise. We'll ask for a small increase, but nothing too crazy. But like I said, there were some good, I think, just some really good things to note, and some good, lessons to be learned from kind of this whole thing. But again, this still isn't a done deal. We'll see what happens. I mean, Jeremy Powell talked about this a little bit this week, basically saying that, hey, Basel III Endgame, we'll try to see if we can get approvals for it, see if maybe we can get something done with it next year. So I think there's still a long ways to go before that thing gets completed. So, okay. Let's go into economic. What do we have coming up next week as far as economic indicators? So on Monday, September 23rd, we have a manufacturing PMI and we have services PMI coming up. On Tuesday, the 24th, we have CB consumer confidence. We have the 2-year Treasury note auction, API weekly crude oil stock. On Wednesday, the 25th, we have new home sales and we also have the 5-year Treasury note auction. On Thursday, the 26th, we have continuing jobless claims, initial jobless claims, durable goods orders, GDP, big one. Yeah, we get some GDP numbers at 8:30 on Thursday morning. Fed Chair Jeremy Powell is going to speak at 9:20, pending home sales at 10. And then we get Fed Vice Chair for Supervision Michael Barr is going to speak at 10:30. And then we have the 7-year Treasury note auction. And then finally, on Friday, the 27th, we have core PCE price index. We have the goods trade balance. We have the Michigan consumer sentiment. And we have the U.S. Baker Hughes total rig count. So a lot of stuff coming up. Thursday, very big day next week. Obviously, the jobless claims data. Initial jobless claims, obviously the GDP numbers, and then you've got Powell speaking, you got Michael Barr speaking. So, big day on Thursday. Obviously, the core PCE index a lot of people will be watching that on Friday. So, a lot of big stuff coming up there next week. So, okay, let's. All right, I was trying to think if I wanted to do news or Fed stuff. So we'll do. I'll tell you what, we'll do Fed stuff first. So let's go in here. So, okay, I'm going to just run through a couple things here. So what was the Federal Reserve? And so this is an article here. We're going to get into this in just a second, but I wanted to just look at, what was the Federal Reserve's big update? So let's take a look at this. So this is the Fed Economic Index. So what we have here is this is the federal funds effective rate. And you can see here that we basically went down to zero starting with the pandemic. And it basically sat at zero there until 2022 approximately. And then we started the Federal Reserve's interest rate increases. And then you can see it got all the way up here to basically 5.33%, because we've been sitting in federal funds always runs in a range of about 25 basis points. So we've been sitting in a range of 5.25 to 5.5%. And it's sat here for a little while now. And then obviously we had the first reduction, basically bringing that down by 50 basis points. So we're now, so we now sit in a range of basically 4.75 to 5% on the federal funds rate. But I love this chart because I think it points out, you can see here, this is the highest that we have been since 2006. Got to go all the way back to 2006. Basically, you got to go back to, 17 years ago to the last time that we were at this level. And then, then you see this come down and then, and obviously because of this, like, what happened here, you get here August of 2007. What happened there? The market imploded with the Great Recession and the bursting of the real estate bubble. And then it kind of, and it just went straight on down. So you're seeing, I heard all week this week, comparisons here between the two. Obviously nothing in remotely happening anywhere close to what's happening in 07. But I'm highly concerned about kind of what's under the hood, what's under the hood there right now. So, okay. So let's come back to that. Let me get back to that. Okay. So Fed cuts set to unwind damage to this bond holdings. So let me just read a couple things here on the Federal Reserve thing. So the Fed lowered the benchmark rate by 50 basis points to a target range of 4.75 to 5%, first rate cut in over 4 years. The Fed sees rates at 4.4% by the end of 2024 and 3.4% by the end of 2025. The FOMC statement released says that in considering additional adjustments to rates, officials will assume incoming data, evolving outlook, and balance of risks. Basically and then what was the reaction rates and markets? So the 2-year Treasury yield fell 10 basis points from the pre-decision levels, but stocks climbed post FOMC decision. So the FOMC announced the following actions and analysis. Now, interesting here, the FOMC votes 11-1 to lower the benchmark rate. So one person said that they did not want to reduce, which is very, very interesting. So the Fed is strongly committed to supporting max employment with inflation around 2%. The Fed tweaks language to note job gains have slowed and says inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. Policymakers suggest a 25 basis point cut at each of the 2 remaining meetings this year. That would be in November and December. I believe there's no meeting in October. What's one of the big takeaways with this right now? I think one of the major takeaways is it not necessarily that the Fed cut rates by 50 basis points, is that the Fed is going to be super aggressive in reducing rates over about the next 18 months. They are going to come out. They're basically going to do two additional 25 basis point rate cuts in November and December. So they're going to end the year by basically effectively bringing the rates down 100 basis points. They're going to do, at least as they're staying right now, basically 100 basis points next year, and then another 50 basis points in early of 2026, which means in total that is bringing the federal funds down by 250 basis points. Which basically bringing it down to a range of 2.75 to 3%. So what's the net effect of that? So if I have like a commercial mortgage, theoretically at the moment, like if I have a commercial mortgage at 7% and we come down 250 basis points, that's going to bring that back down to about 4.5%. Pretty good. Definitely, I think a lot of people will take that right now. And we're going to see here, like, why is that a big thing? And that's where this article right here. So Fed cuts set to unwind damage to U.S. banks' bond holdings. So what did we just talk about with the Basel III endgame? The proposal is they want the regional banks to basically hold additional capital, and they want them to show, or account for what unrealized losses do you have in your bond portfolios. And that's where basically the Fed is also going to help out here. So U.S. banks are poised to slash unrealized losses on bond portfolios as the Federal Reserve appears ready to initiate a steep rate cutting cycle. So the industry posted an 8.26 billion sequential improvement in accumulated and other comprehensive income, AOCI, to a loss of 254 billion in the second quarter. According to data from S&P Global Market Intelligence, the AOCI includes unrealized losses on available for sale securities, and banks notched the advance even though interest rates, which move inversely with bond prices, increased modestly across most of the Treasury yield curve during the period. Now I want to go, and then they give kind of a couple, they talk about, Treasury yield curves kind of tumbled a little bit, but here's the chart. Here's what I wanted to show everybody. So you can see the dramatic impact of this. So, and this goes right along. When did the Federal Reserve basically start increasing interest rates? Oh, right here. That's right. Oh, right around the second quarter here of 2022. And so you can see the effect that this has had on these. So this is what's called unrealized losses in a bank's bond portfolios. So these, in other words, they're losses that have not yet been realized. So it goes like this. If the bank holds the bond to maturity, they will make money because they will earn the return that they originally contracted when getting that bond. So they won't lose anything. They'll be fine. However, if they had to liquidate that bond today, they would incur these losses. Now, why might that happen? Well, if you have a problem, if you have an issue at the bank, say you start having a bunch of real estate loans go bad, say your capital starts to drop, you need liquidity, you need money, you need to beef the capital back up, you need to refill the coffers, you need to put more money aside for what's called loan loss reserves. Well, in that event, you might have to liquidate some of your investment portfolio, i.e., these bonds, and get liquidity. You need cash fast. You need liquidity back in. That and therein kind of lies the problem. As long as nothing hits, then you're good. But as we saw, what happened was with like Signature Bank, Silicon Valley Bank last year, like when they had the run on the bank, when they had the deposit run, they needed liquidity to fund that out to help try to stave off that outflow of deposits, and so they were forced to sell the bonds in their portfolios at dramatically steep losses. I think Silicon Valley Bank, like I think they took, I don't know, a huge, like a $20 billion hit, something like that, on their bond portfolio as they tried to save themselves, but it still wasn't enough. So that's the issue with this. Like that's the issue. If you just let the bonds play out and everything's fine, it's fine. If you have an issue at the bank though, and you need liquidity and you have to get out of these bonds quick, you're going to incur hefty losses, and this is for the whole industry. So it's a big issue. But what the hope here is that as the Fed reduces the interest rates, that will really help this issue here. It'll help get them back, help narrow this loss down, and help get them back to like a positive territory. And let's see here. So it says most of the 20 biggest banks by assets posted sequential improvement in AOCI, and 15 had gained in adjusted TCE. The shifts reflect the bond maturities and changes in portfolio composition, in addition to fluctuations in interest rates. Truist Financial led the way on AOCI with a 35.7% improvement to a loss of $8.5 billion after selling its insurance brokerage and executing a bond repositioning. So its adjusted TCE improved 48.3% to $30.63 billion. PNC Financial Services Group posted a 7.4% improvement to its AOCI to a loss of $7.45 billion. So in other words, these two banks, Truist and PNC, they took major losses to reposition their bond portfolios. Truist lost $8.5 billion. PNC lost $7.45 billion. I mean, these are big numbers. And then this is just a chart here, the AOCI and adjusted TCE at largest U.S. banks, second quarter. So like you can see like Citigroup, Wells Fargo, just looking at the red here. So, all right, we're not going to go through all that, and we can come back to that at another time. Let me see here. I want to get into this in a minute. Delinquencies rose. Okay. Fed rate cuts mark a key turning point for regional bank, analysts say. So the Federal Reserve's recent move to cut interest rates by 50 basis points serves as a key turning point for regional banks, which faced several major headwinds as rates rose from March of 2022 to July of 2023. JP Morgan analysts said the headwinds include pressured net interest margin, in other words, what they call margin compression, as deposit costs rose, anemic industry loan growth as borrowing costs increased and business confidence dampened, and elevated concerns over credit quality trends with a focus on commercial real estate. These headwinds will now change direction and eventually become tailwinds, the analyst said. In addition, with short-term rates falling, the yield curve is also de-inverted, which not only represents a path toward improved net interest margin and earnings, but in our view also signals a widening runway for a soft landing, a key catalyst for generalist investors to start returning to the sector again. And then let's see, it goes down here, and that's kind of so. What they're saying there is that you have. Let's go through this for a second there. So you basically have anemic loan growth because of the high interest rates. People basically weren't borrowing money. And it was basically kind of sapping business confidence. You had elevated concerns over credit quality trends. In other words, not only delinquent loans, but basically like what you call non-performing loans, basically building up on bank. You could also classify that as criticized loans or criticized assets, kind of building up on banks' balance sheets right now. So with a focus on commercial real estate, obviously with the office sector, those issues there. So, but they're saying, these headwinds will now change direction. Um, so in other words, what they're saying is that, basically business borrowing will pick up as the rates come down. Probably should happen, probably very true. Business confidence will kind of pick up a little bit. And but I think more importantly, as those rates come down, as banks have to roll the debt, they get loans that come up to maturity. They have to, they got to reset the interest rates on them. It'll make it much easier to do that. Like right now, what you have is a situation with a lot of banks have gone into kind of this extend and pretend mode where they're just extending the loan maturities out, hoping that things would get better. Now, what's interesting though is that, you can reduce the interest rates, but this is not going to take effect overnight. Like this is going to take a while to kind of work through. I mean, you've got at least a good year. You're probably looking at this time next year by the time a lot of this stuff probably starts kicking in. So just a point of note there. So, all right, I just want to read this Fed press release, and I'm going to look at a couple other things here real quick. So the recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have slowed, and the unemployment rate has moved up but remains low. Inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment inflation at the rate of 2% over the long run. The committee has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks on both sides of its dual mandate. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range for the federal funds rate by 0.5%, blah, blah, blah. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. So, I don't know, kind of standard statement from the Federal Reserve there, if you will, but they're basically saying that, the economy looks good, but I'm going to share a little tidbit here. The Federal Reserve would not be reducing interest rates as aggressively as it now is if they were not highly concerned about the economy. Obviously, we got a lot of, we keep getting these economic numbers, and I've been harping on this for months and months and months. We keep getting these economic numbers that have great headlines, and then a month later, the numbers get revised downwards. And in the case of jobs, we basically found out that there were 800,000 jobs that, poof, just didn't exist. And again, coming back, there's something else I'm looking here. No, that's not what I'm looking for yet. Hang with me here for a second. No. Here we go. Okay. So what are we going to get to? So Fed's big cut boosts inflation risk, odds of a policy correction. So anxious about recent cooling in the domestic labor market, the Federal Reserve launched its rate cutting cycle this week more aggressively than most in financial markets had recently anticipated, boosting the risk of sending inflation higher. Oh, wait. What? What's that? Boosting the risk of sending inflation higher and potentially limiting just how far the central bank will ultimately lower rates. The Fed's rate-setting Federal Open Markets Committee on September 18th approved cutting its benchmark interest rate by 50 basis points, its first cut since it began hiking rates from near zero in March of 2022. That ultimately pushed them to the highest level in more than 2 decades. With equities trading near all-time high, the economy growing at a near 3%, inflation moderating, but still above the Fed's 2% target, and unemployment still near historic lows, there is some concern that the central bank's larger than many expected cut could pose unnecessary risk to a financial system with little apparent stress. Did they just overcook it a little bit? Maybe, said Jack McIntyre, portfolio manager with Brandywine Global, in an interview. If the economy muddles through and reaccelerates, the Fed is going to have to tighten again. That's a real risk. So, in here you just have, joblessness slowly rising, inflation falling. So we have, personal consumption, the PCE basically going down, unemployment going up. Now, here's the thing: reverse course. Fed watchers cautioned the 50 basis point move could become a policy misstep, one the central bank may need to repair if inflation moves further from the 2% target. It's not impossible that the Fed pauses or even reverses course if the economy reaccelerates, said James Camp, managing director of strategic income at Eagle Asset Management. Camp sees the Fed cutting by another 50 basis points before year end, as interest rates settle into a neutral level of between 3.5% and 4% at some point in 2025, as the Fed likely pauses rate moves, that the delay of significantly lower near zero rates are likely over. And then he just goes on to say, the economy is fundamentally different. And then let's go here. Okay, peak during the summer. Okay, so here's what I want to show everybody, though. Let's see here if I can find. This is kind of funny. I can't say that, but you can read it. Hopefully you can see it. I'm going to print so much blank money. That's pretty funny. That's good. I just want to see here. Yeah, gold's hitting an all-time high. If anybody hasn't been paying attention, gold hit 2605. It's a big number for gold. So for anybody who doesn't know, there's another way to interpret the value of gold, and this is what central bankers hate. One way to look at or interpret the value of gold is it's a judge of how well the central bank is performing. If people perceive the Federal Reserve to be doing a horrible job, the price of gold is going to go way up. Okay, that's a big reason why central bankers don't really like to talk about the price of gold, because this kind of points out that they're doing a horrible job. Just as a sidebar. So, okay. All right, what am I looking for here? Okay. So three inflationary waves in the 1970s. Let's see if I can make this. Yeah, here we go. Okay. The three inflationary waves of the 70s. So yeah, the first wave, and then 1970, 1974 goes up. So what happened here? And this is what I keep pointing out. What happened here? The Federal Reserve ratchets up interest rates, and then what happens? Inflation started to come down. And then in 1975, what did we have? Oh, wait, that's right. We had an election year. So then basically they thought they had beaten inflation. And this is the other thing. Does this chart look like a straight line? Does anybody see a straight line on here? No. Inflation does not move in a straight line. It does not go straight up. It does not go straight down. And inflation is not a economic phenomenon. Inflation is caused by the government. It's caused by the government printing too much money. That's what causes inflation. What are we doing right now? Oh, that's right. We're running multi-trillion-dollar deficits every year. That's right. So we're spending and printing way too much money. Okay, but I digress. But here's what happened here. So they increased interest rates. Inflation started to come down. They thought they had inflation beaten, but they stopped too soon. And they basically started bringing the interest rates back down. And what happened here? Inflation took off. It took off and soared to the moon. And then we had an issue of, we had our Paul Volcker moment. Paul Volcker had to come in. He had to jack interest rates through the roof to cause this effect, to bring the inflation back down. And what I am worried is that our setup looks exactly like this right now. And I'm terrified that the Fed has think that they have beaten inflation, and they haven't. And our government is still printing money like crazy and still running major deficits. And we have our national debt is at an all-time high. It's like $36 trillion. So if the Fed messes up here, it is going to be a colossal mess up. And if we end up with this, people are going to be freaking out. So, okay, let me try to find, if I can find this setup here. Volcker's Folly, average cost. So look at this. Yeah, Saudi central bank caught secretly buying 160 tons of gold in Switzerland. They're not stupid. Here we go. All right. This is what I was talking about here. Inflation back to 1949 using today's methodology. So this follows right with that chart from the 70s that I showed you. 1971, 74, 76. And so you see how so the blue line here, that's from the 70s into the 80s. And the orange line is us here today. And you can see this is exactly what I'm talking about. You see, we are almost mirroring this chart. And so, and I'm worried that that's a steep peak right there, man. It's a steep peak. And that's what I'm concerned with right there. So, but okay, here's some other things real quick. So, the Fed just cut interest rates. What does that mean for you? The Federal Reserve cut its influential federal funds rate by 50 basis points. With the rate cut, borrowing costs for all kinds of loans should decrease. Yes. Not, I mean, is it going to make a monumental difference? No, but every little bit helps, right? Hiring has slowed down over the past few months as high interest rates have started slowing the economy. Lower rates mean business loans are more affordable and employers may be encouraged to hire. While the rate cut will lower borrowing costs and increase hiring, savers will likely lose their high returns on different savings products. Yes. So basically, we're gonna go back to that's the trade-off. If rates drop, we're going to go back to a point where people aren't going to be able to get these very nice returns that they've enjoyed for the last year and a half on their savings accounts. So what sectors could benefit the most from the Fed rate cut? So the S&P 500 traded near a record high on Wednesday, immediately after the Federal Reserve's first interest rate cut in more than 4 years. Anticipation of the cut, which ended up being 0.5 percentage point, boosted stocks, especially in rate-sensitive industries like home building and pockets of the financial sector. Analysts said substantial uncertainty and stocks' impressive pre-cut performance could limit post-cut upside. So as it basically just goes on to say, like, there are other sectors that can benefit. We talked a little bit about the dot plot. Fed unveils expectations. We talked about the bond portfolio stuff. We talked about the odds of a correction. So I think we got our Federal Reserve stuff covered here for the moment, or at least the stuff that I wanted to kind of hit on and go over there with the Federal Reserve. So let's get into what else we got here. Okay, so let's go. Let's blow through some news here real quick. So, home sales fell in August despite lower mortgage rates and more inventory. So home sales fell 2.5% in August from July and remained near historic low levels. Falling mortgage rates and increasing number of homes for sale have yet to break the housing market free from gridlock. Major reason for the frozen market is the lock-in effect caused by the difference between today's high mortgage rates and the super low ones available during the pandemic, which discourages homeowners from selling. Falling mortgage rates could help the situation, but affordability likely won't improve much until the country's chronic housing shortage is fixed. I could go on a whole discussion. The interesting thing there with the housing thing is that two things. Number one is that just because interest rates come down, that helps with the affordability issue, but it does not fix the affordability issue. And they talk about the chronic housing shortage. Well, when you let in 20 million people, that's going to cause a problem with housing. And the big issue there, the major issue there, is that we don't have the home builders to build the amount of housing inventory that is needed to help, I guess, correct the issue. So that is what I see as one of the big problems. You don't have the home build, like you've got the big, see, the home building industry was totally different pre 07 and 08. You kind of like your mom and pop builders, then you had kind of your middle tier builders, and then you had your bigger builders. Now, those middle tier home builders were completely wiped out. They no longer exist. You basically have the big six home builders, and then you've got a whole bunch of mom and pop operators, and you have people that do land deals and other things like that. But that middle tier home builder that would come in and say, you know what, I'm going to build 30 townhouses over here, and I'm going to build 25 single family homes or 50 single family homes in this, and make a new home development or whatever. They're gone. They don't exist, and that's a major problem. So something is going to have to kind of get that rolling again. So okay, jobless claims fall to the lowest level since May. Initial jobless claims dropped from the prior week to 219,000, surprising on economists who forecasted that new unemployment filings would be larger. Half of America's rental households are considered cost burdened. Although a slowing rental housing market may mean more concessions and even rent cuts in some locations, effectively half of America's renters currently are considered cost burdened. That's according to a one-year estimate from U.S. Census Bureau's 2023 American Community Survey released last week. It found 21.1 million renters spent 30% or more of their income on housing costs last year, a reference to a commonly used threshold for household affordability. That volume represents 49.7% of the 42.5 million rental households in the United States. So interesting numbers there. Inflation is apparently no longer the top worry for executives. But in this says, inflation is not their top economic concern, but even as things appear to be improving in that area, only a quarter expressed optimism about the economy over the next 12 months. And let's see here, CEOs, chief financial officers, controllers, and other certified public accountants to assess how executives feel about the economy. They expressed optimism, but they also, there's still a lot of concern there. So let's see here. We covered that. Yes. Okay. Let's go back to a couple of delinquency things here real quick. So let's go back to this article on delinquency. Delinquency rose in large banks' non-owner occupied commercial real estate books in the second quarter of 2022. So delinquencies on loans at large banks backed by non-owner occupied commercial real estate properties, in other words, investment properties, rose again in the second quarter as the segment continued to be a unique area of concern for the biggest lenders. For banks of most sizes, the delinquency rates are similar for commercial real estate loans on owner-occupied and non-owner occupied properties, but for banks larger than $100 billion in total assets, CRE loans on non-owner occupied properties have shown notable weakness in recent quarters, with worsening performance in the most recent period. The delinquency rate for such loans was 4.94% in the quarter, up 53 basis points sequentially, compared with the delinquency rate of 0.99% for 100 billion plus banks, CRE loans on owner-occupied properties. Among the largest bank, the ratio for net charge-offs to loans in the non-owner occupied real estate segment was 1.62%, up 49 basis points quarter over quarter. So a jump of about 50 basis points is a considerable jump in your delinquency there for non-owner occupied properties. So again, this is a very interesting thing that I wanted to point out. Let's see if we can go down here. I just want to see if there was something else here I wanted to point to. So, all right. So then the other thing I wanted to point out was retail. What's going on with retail commercial real estate and retail delinquency? So This was an article that basically said what Chapter 11 bankruptcy filings by retailers will mean for commercial real estate. So, Columbus, Ohio-based Big Lots became the latest major retailer to file Chapter 11 bankruptcy protection earlier this month. It plans to close more than 300 stores as part of its restructuring. Big Lots filing comes after mall and open air center staples like Rue 21 Inc., Express Inc., and The Body Shop International announced plans earlier this year to close hundreds of stores. Discount retailer 99 cents only 99 cents only stores said this spring it would close all of its 371 stores. LL Flooring Holdings and Cons Inc. Also have filed for bankruptcy this year, as did Red Lobster, with the Orlando, Florida-based chain closing more than 100 restaurants as part of its recently concluded Chapter 11 proceedings. Most of those sites were freestanding out parcels of shopping centers. All of that activity follows last year's bankruptcy filing by Rite Aid and Bed Bath & Beyond, with those moves continuing to have a significant ripple effect on the broader retail real estate economy. Rite Aid's reorganization plans called for more than 800 stores to be shuttered. Bed Bath & Beyond closed nearly 900 locations. So when you add all that up, that's a lot of stores. That's a lot of stores, man. I mean, you're talking about thousands and thousands of stores. So now the question here is, will retail real estate debt take a hit? Yes, unequivocally. So the commercial mortgage-backed securities retail special servicing rate, which tracks the retail-backed loans that have a special loan servicer assigned to them because the borrower is struggling to keep current on payments, is at 10.92%, according to TREP data. That's higher than the overall CMBS special servicing rate of 8.46% and second highest among property types behind only office. So according to TREP, Big Lots CMBS exposure includes 194 properties and 169 loans with a total exposure balance of $488 million. Cons, meanwhile, has a CMBS exposure of 38 properties and loans with a total exposure balance of $101 million, according to TREP. So the wave of store closures and bankruptcies within this segment of the retail sector has significant implications for commercial real estate, TREP wrote in a report. Vacant retail spaces, especially large anchor stores, can have a cascading effect on shopping centers and malls, often leading to reduced curb appeal, a decline in foot traffic, and reduced revenue for other businesses in the vicinity. Property owners and landlords are left scrambling to find new tenants, often at lower rents, which further strains the financial performance of debt and equity investments that comprise the commercial real estate market. So yes, we have. So what is the concern here? The concern now is that you're beginning to see this buildup of retail businesses going out, and not just little, like we're talking Big Lots, we're talking, Bed Bath & Beyond. We're talking about some pretty big retail operators, Rite Aid, and they occupy big spaces in these. There a lot of these guys would be considered anchor tenants in a lot of these shopping centers. I mean, yeah, you've got the food store, which is probably like your main anchor tenant, but you can also have there can be more than one anchor tenant. And for those that don't know, your anchor tenant is basically that's the big retailer in a specific shopping center or a mall that basically drives in most of your traffic. So in most shopping centers, your food store is going to be, I'll use like Wegmans. What are some of the other ones, like Kroger, like things like that? Like that's going to be your big draw into that, particular, shopping center. So, and then you get like I said, and then you get the things, usually the standalone parcels kind of surrounding the shopping center, which could be restaurants, could be Rite Aid, could be some of these other ones, Bed Bath & Beyond, Big Lots, so it's interesting here, and that you're now beginning to see the delinquency go up. These non-owner occupied properties, which is your retail properties, it's your office properties, it's anything that is basically owned by an investor. So again, just a very important, very interesting thing to point out. I'm just looking and see if there's anything else I wanted to touch on here before Oh yeah, let's take a look at M&A for just a minute here. So okay, so I brought this article up here just because I wanted to show everybody. Here just this is just kind of a general update on the merger and acquisition activity in banking right now. So where are we at so far for the year? So year to date 2024, we're basically at 83 deals. Total deal value 10 point, I guess it's 10.93 billion. Yeah, it's billions. Um, and and where does this compare? I mean, deal value much higher than what we had here in 2023, but we're about to enter the fourth quarter here in another couple weeks. Um, if I had to guess, I would say with the reduction in interest rates, we'll probably see a few more transactions throughout the rest of this year. Like we'll probably get over that 100 transaction mark. Like in other words, will there be another 20, 25 deals announced in the fourth quarter? I would probably say so. Yeah, I'd probably say that's a thing. Are we going to get up to 2022 levels? Like, are we going to get to 155 transactions this year? I doubt it. I mean, that would be one heck of a fourth quarter to get up to 155. But so you can see there that obviously 2020 with the pandemic, mergers, very very low. 2021 picked back up again. I mean, some of those were kind of holdovers. But so overall, if you take an average of the last 3 years, I mean, M&A activity has been really down. I would say if you look at between like 2010 and 2020, you probably average somewhere in the neighborhood of 225 to 250 M&A deals a year. So so you can see that it's. I mean, there's still activity there. There's still deals going on, but it's definitely more muted than it was before 2020. So just wanted to kind of show that to everybody, just to give everybody a little bit of update there as far as like what was going on there. Okay, now I want to get into real quick the big news that kind of came out this year, with the basically M&A kind of activity that was going on here. And let's flip over. Okay, no, that's the banking and service. We'll come back to that in a minute. We got that already. Got that. Okay, here we go. Trio of merger policies expected to constrain bank deals. So I want to kind of build up to this for a second, though. I want to just go through a couple other things with you guys real quick. So, I'm going to read that back. Okay. All right. So, couple different agencies here. We had the OCC, we had the Department of Justice, and I believe we had the FDIC. So they all came out this week, all came out basically the same day, basically announcing guidance on bank mergers. And so the first thing was the OCC approves a separate rule guidance on bank mergers. So the OCC approved a final rule updating its regulations for business combinations involving national banks and federal savings associations, and a policy statement clarifying its review of applications under the Bank Merger Act. So basically effective January 1st, 2025, the OCC's final rule includes regulatory amendments that will remove expedited review procedures that allow certain filings to be deemed approved as of the 15th day after the close of the comment period. Remove a section that specifies situations in which an applicant may use the OCC's streamlined business combination application rather than the full interagency BMA application. And then the DOJ rescinds bank merger guidelines in favor of generic standards. So the Justice Department announced that it is unwinding its 1995 bank merger guidelines, saying its 2023 merger guidelines for all industries will be its sole and authoritative policy. The DOJ also released an addendum explaining the application of the 2023 guidelines to banking. The commentary identifies competition issues that may commonly occur in bank mergers and outlines guidelines that inform analysis of those issues. So the guidelines note that industries trending toward consolidation may be subject to additional scrutiny, indicating bank mergers could receive stricter review. So, all right. And then the FDIC finalizes rule on custodial deposits. So the FDIC Board of Directors issued a proposed rule that would require increased record-keeping responsibility for banks that hold custodial deposit accounts with transactional features. So the FDIC defines banks that hold custodial deposits as those in which the account is established for the benefit of beneficial owners, the account holders commingling deposits on different things. And you know what? I just realized that this is the wrong thing. This was the wrong statement from the FDIC show. This was not. I did not want the piece here on custodial deposits. But one favorable thing that has come out of this before I continue on is that the FDIC did decide to include credit unions in their merger guidance. So basically, the FDIC statement of policy on agency reviews of bank mergers says transactions involving a credit union may require additional information about their impact on the convenience and needs of affected consumers because credit unions are exempt from the Community Reinvestment Act. Typical concentration measures such as the Herfindahl-Hirschman Index might be insufficient in rural markets, particularly those served by credit unions, farm credit system institutions, and other banks. So I think that was a very interesting thing. So in other words, now when credit unions go to buy banks, that will probably get scrutinized a little more. So, okay. So basically what happened here, so Monday, September 16th, bank regulators maintain M&A market concentration guidelines despite the DOJ update. So even though the U.S. Justice Department updated its antitrust guidelines in December of 2023, federal bank regulators have not changed their own rules on measuring competitive effects. So we kind of went through that, and then it came down to, then the next day on the 17th, the FDIC finalizes merger policy statement with a few changes. So the FDIC finalized its guidance for bank mergers, keeping it largely the same as proposed earlier this year. The guidance will apply primarily to state banks that are not members of the Federal Reserve System, though mergers involving an insured depository institution and a non-insured institution are also subject to approval from the FDIC. So, and then we get down here. So TRIO. Now we can kind of, sorry, I had to kind of build this up. So now we have like the trio of merger policies expected to constrain bank deals. So the Federal Deposit Insurance Corp, the OCC, finalized their bank M&A policies on the day that the Justice Department issued a clarification, all potentially constraining banks' M&A activity. These changes have been anticipated, and both the FDIC's final statement of policy and the bank regulator's final rule are similar to the proposed versions. The FDIC's guidance will take effect 30 days after being published in the Federal Register, while the bank's regulator's rule will take effect January 1st, 2025. The Justice Department's Antitrust Division's clarification noted that it would apply its new guidelines from December 2023 if it reviews a bank merger, therefore withdrawing from the 1995 bank merger guidelines. In addition, the division gave some examples of parts of the guidelines it considers to be frequently relevant when evaluating the competitive consequences of a bank merger, such as looking at potential competitive advantages. And that's the part that kind of gets into like the credit unions. Okay. So basically what's the takeaway from all that? What's the gist of all that? So the gist is what I just showed you guys when we looked at the merger numbers here. So is all of that stuff that's being done by the FDIC, the OCC, the Department of Justice, is that going to help increase bank mergers or make bank mergers easier to do? No, it just as that article said, this is going to continue to constrain bank mergers. It's going to continue to slow down the process. Yes, they threw you one kind of goodie there where okay, that might make it a little bit harder for credit unions to buy banks. Okay, that's probably a good thing, but will it completely stop it? No, credit unions will continue to buy banks, but it's going to gum up the work of mergers and acquisitions. It's going to continue to drag out the process, continue to increase the costs of banks trying to do mergers. So I think overall, like, not a great thing, necessarily for the industry. So, okay, now I want to get into a little bit of update on the BaaS, so Banking as a Service. So, a couple of things here. So the FDIC proposal here They came out basically to require daily reconciliation in banking as a service. So the FDIC is proposing a new rule requiring that financial institutions maintain clear records detailing the total deposits that end user customers own when they deliver banking services through financial technology partners. All 5 FDIC board members voted to support the rulemaking process at a meeting on September 17th. The FDIC will be seeking comments within 60 days after the proposal is published in the Federal Register. Under the proposed rule, financial institutions that offer custodial deposit accounts with transactional features would be required to conduct reconciliations at least once a day at the close of business to ensure the accuracy of deposit balance records. Using custodial deposit accounts, banking as a service providers commonly aggregate all end user deposits of a fintech partner into one such account. So this is, you could call this the Synapse rule. You could call this the Evolve Bank rule. And a very interesting thing here that happened today. So Evolve Bank and Trust basically got sued a couple of days ago, and I'm trying to think. I don't have the. I thought I had the article here with me, but I didn't have it. But basically, trying to see here if it said anything. Did not. But basically, Evolve Bank and Trust is getting sued, basically claiming from, and I don't think it was from Synapse, because Synapse filed bankruptcy. I think it was a Yodel, Yoda, whatever, one of these fintech companies out there, basically is suing Bank Evolve IP, not Bank Evolve, Bank Evolve Trust, Bank and Trust. I'll get it right here sooner or later. Evolve Bank and Trust. They are, suing them, basically claiming that they mishandled funds, because basically you've got about $85 million right now that's missing. And, this was money that was coming through the fintech. So they were technically uninsured. They, not FDIC insured deposits. So it becomes a question of, well, who's going to pay for it? So now you've got regulators going in here, but now we've also got something else here too. Fintechs mull bank charters as regulatory pressure on partnership ramps up. So financial technology companies are increasingly looking into the possibility of getting bank charters, though few have actually taken the plunge. Heightened regulatory scrutiny in the banking as a service has fintechs taking fresh stock of their reliance on bank partners. However, if deploying deposits for lending is not core to their business models, fintechs have tended to walk away from getting their own bank charters. The number of inquiries we got increased, but the number of people who wanted to follow through on that has not been all that high. Inquiries sparked during the March 2023 turmoil that saw several crypto-connected banks fail, Crane said, and also picked up following recent incidents around Evolve Bank and Trust, BAS provider Evolve, and its middleware vendor Synapse Financial Technologies, which filed for bankruptcy in April, encountered issues and reconciliation. That's a good, nice way to put it. Issues and reconciliation to the tune of $85 million. They caused difficulties with distributing funds to depositors because ledger records did not match. So I think it's interesting. You have several banks around the country that have kind of created this business niche for themselves, if you will, in the banking as a service space. But the regulators, now that we've had this big blow up here with the failure of Synapse Financial Technologies, they're starting to put the screws down now with this new proposed rule, basically saying, hey, you're really going to have to keep an eye, and you're really going to have to keep track of these accounts and the money and where the money is flowing in and out of. And you're going to have to basically, reconcile a register, at the end of every day to make sure that this stuff doesn't continue to blow up and people are losing money. Again, this is just going to add, more difficulties to banks trying to do business with fintech partners or fintech companies that they want to try to partner up with or hire to provide a service. And, now it's got, again, we've seen this before in the past, fintechs really start looking at bank charters, but a lot of times that goes nowhere because of the amount of regulation that they have to take on. again, all these fintech companies, they all want to be banks. They all want to be able to do what banks do, but none of them want to take on the regulation at the end of the day. None of them want regulators coming in, basically prying around, going, "Hey, what are the security protocols that you guys have? And have you guys vetted all these vendors you're working with? And what's your track record on this? And how do you do that? And everything like that." And they just don't they don't want to deal with it at the end of the day. You know, this is why you haven't seen PayPal become a bank. This is why you haven't seen Block get into banking. This is why Walmart continues to stay out of banking, why Amazon continues to stay out of banking, because they want to be able to do it, but they don't want the tags that come along with it, if you will. So okay, let's see. Do I have anything else here today? Let me go back to favorite Twitter channel here. Let's see here. Let's see what we'll go through a couple things here. This is fun. World debt has crossed a staggering $300 trillion. Oh wait, I lost it. Let me go back down here. Hang on. I'll find it. How far down? Oh, this is kind of funny. The Fed says the new $1 bill will look like this after today's rate cut. If you get it, you get it. Federal Reserve cumulative losses have reached a massive $188 billion over the last 2 years. That's a heck of a chart. That's losses at the Federal Reserve right there, ladies and gentlemen. Yes, $188 billion heading toward the $200 billion mark. So typically, what the Fed does with its profits is it will send those profits over to the United States Treasury, as you can see in this chart here to the left. But then you see as this goes down, basically, there have been no profits to be seen here to be handed over to the Treasury. So, let's see here. Fun fact of the day. Next week, the Fed will cut rates for the first time this cycle on September 18th. It was the same day, September 18th, the Fed first cut rates in 2007. Just a funny coincidence, or is it? Again, here, another chart, like I said, detailing out the 1970s versus 2020s. And you can see we're just following this thing right along. And the question is, are we gonna end up here at the end of the day? Let's see here. This is it. U.S. construction lending for homes dropped 10% year over year to $92 billion in the second quarter of 2024, the largest decline in over 10 years. This marks the fifth consecutive quarterly decline in construction lending for this sector. Meanwhile, U.S. housing starts fell 16% year over year in July to 1.24 million, a 50-month low. For the full year, housing starts are also expected to drop by 16% from 2023, according to government data. So this is an interesting chart here. So China's holdings of U.S. Treasuries are down to $780 billion, near a 15-year low. Over the last 3 years, China's Treasury holdings have declined by 30%, or $300 billion. Since the 2013 peak, China has dumped a total of $540 billion of Treasuries. See here, now foreign holdings of U.S. Treasury securities as a share of outstanding federal debt is down from 35% to 24% over the last decade. This share sits now near the lowest level in 18 years. China can't stop selling U.S. Treasury securities. So, I mean, look at that. That's crazy. And this gets back to the point I make. Let's take a look at bond rates for a second here. So, okay, here are the U.S. Treasury bond rates. Okay, we got the long end of the curve, which is the 30-year, the 10-year, 7-year, 5-year, 3-year, 2-year, and then we get the short end of the curve. We get the 1 year, 6 month, 3 month, 1 month. You will notice how high the short end is: 4.7, 4.6, 4.4. and it's still higher. Now, most people look at the yield curve and they take the 10-year note minus the 2-year, and that kind of gives you where you're at. And you can see that the 10-year at 3.7 is higher than the 2-year at 3.6. So we have China just nudged our way back over to positive territory. However, I would maintain that the yield curve still has not reverted to positive territory fully, because your 10-year note is still 100 basis points below the 1 month. It's still almost 100 basis points below the 3 month. It is 80 basis points below the 6 month. It's still below the 1 year T-bill, but it's getting closer. We're getting closer back to that inversion. So here is the issue. And I'm trying to think how I can easily explain this. So you have Janet Yellen over at the Treasury, and I covered this in issue a couple weeks back, an episode a couple weeks back. So the Treasury has been buying all of these short-term T-bills, okay, driving up the price of the short-term Treasuries. Now, are they going to continue to do that? I have maintained that they cannot continue to do that forever. And basically, at some point, this is going to start leveling out. But you have basically $1 trillion in treasuries that are sitting out there that are going to need to be rolled over into longer term treasuries. Who is going to buy this? That's the question here. Who's going to buy this? China's not buying our debt. Japan is not buying our debt. Those are the two largest purchasers of our national debt, and they're not buying. And our government won't stop spending. We've got to fund it. And so we're just going to fund it and just buy our own debt. Is that how? I mean, we do that, but I'm just saying, like, is that how it's going to be? Like, we're just going to basically run the largest like Ponzi scheme the world has ever seen until it just completely blows up in our face. Is that how we're gonna roll with this? So, but my point being here is that your longer term treasury is going to go up. Like you're going to see in this next year a very crazy thing. You're going to see the Federal Reserve reducing interest rates, and you're going to see the 10-year note rising. And what's tied to the 10-year note? Oh, just about everything. Like, your mortgage rates, your auto loans, credit card rate, like everything is tied in one way or fashion to the 10-year note. So it's an interesting thing to kind of, keep an eye on there. So, all right, do we got anything else here? Let me just see here. I'd like to read this, but I don't have the time. This is actually really good. This is Michael Burry's, his investment one sheet is where, basically his strategy for investing in stocks is really good. If anybody has a chance to go read that. I'm not going to get it. Retail sales were up, but is that really a good thing? Probably not. So, all right, let me just check here. Do I have anything else there? Yeah, you know what? I got one more thing I'll share. I'll go in with you guys here. Well, actually, two things. Okay, so private sector companies join tokenization projects. So more than 40 private sector companies will join a group of central banks in Project Agora, which will explore how tokenization and a wholesale central bank digital currency could enhance cross-border payments. Basically a wholesale central bank digital currency as opposed to a retail central bank digital currency is intended for use only by banks and central bankers. That's funny. I thought we had this thing called the SWIFT system that, enabled you to send money all around the world. So why do we need this? But I don't know. That's just me. Okay. FinCEN. It's probably my favorite thing here. FinCEN publishes Beneficial Ownership Toolkit. So the FinCEN basically published a toolkit for small business owners with beneficial ownership reporting requirements. The toolkit contains templates and sample content, a general background on the reporting requirements, templates for newsletters, websites, and emails, sample social media posts and images, and information on contacting FinCEN. So under the Corporate Transparency Act, a bipartisan law enacted to curb illicit finance by supporting law enforcement efforts, many small business owners are now required to report basic information to the federal government about the real people who ultimately own or control them. So they published this toolkit, but then they also basically issued a statement that they basically said, don't wait to file beneficial ownership reports. Basically, at the latest beneficial ownership information reporting event in Philly, FinCEN Director Andrea Gaki noted that while small businesses created or registered before this year must file by January 1st, 2025, they don't have to wait. Further, those created or registered this year have 90 days to file an initial report, and that period drops to 30 days next year. Willful violations. So Gaki reiterated that small business owners doing their best to comply with the law should not lose sleep over these new reporting requirements. She noted that the CTA penalizes willful violations of the law, and that this is where FinCEN plans to focus its enforcement actions. How in the world are they going to determine what is a willful or a non-willful violation? Okay, if I don't know about it, and I literally, couldn't anybody just walk in and say, I had no idea? Because most people have no idea about this. Most people have no idea. But I mean, how, okay, so you walk in and you say, oh, I have no idea. Are they going to then sit there and be like, no, that's ridiculous. This is willful. And the violations on this are insane. It's like $10,000 and like 2 years in prison. 2 years in prison if you don't comply with this and fill this stuff out or whatever. So, but there's a big court ruling that's going to be coming down here, should be coming down here very shortly here. And I've been telling people just to kind of chill out and wait until that court ruling comes down before you make any decisions, and we'll kind of see what happens there the rest of the way. So I would just I will definitely do more of an update on the beneficial ownership information stuff here in the next couple of weeks as more information rolls out. But I would just tell everybody, just hold tight on that. We'll see what happens. I do not like the beneficial ownership stuff. I think it's ridiculous. I think it's a complete in violation of privacy. I don't think we should have it. I'm appalled at the way that people will be able to get access to this database. Foreign countries can get access to it. Any government agency can get access to it. It's just horrible. And the lawsuit that was filed on behalf of the Small Business Association, the National Small Business Association, they basically said that it violates 10 amendments to the Constitution. So again, we'll keep an eye on that, and we'll see what happens. We'll see how it plays out. But that's all I got for everybody tonight. So I hope this was, I know this was kind of a lot of information. We covered BAAS stuff. We covered, what's going on with regulations as it relates to bank mergers and acquisitions, a lot of Fed information, a lot of financial data, different things going on. Updated you guys on episodes that are coming out. So this weekend, I want you to keep it. This is kind of like SBA weekend. So I've got a great interview coming up with a good friend of mine, Paul Avery, who is a senior vice president, SBA lender at local Meridian Bank here in the Philadelphia market. And I did a whole interview with him just on SBA loans, how do you get SBA loans? What's involved? What's the process? What's the time frame? What are the different programs that SBA offers? So it was a great interview with him. That'll be coming out tomorrow. And then on Sunday, I'm just doing kind of a general SBA update where I'm just talking about what are some of the updates that have been happening, what are some of the issues that SBA is dealing with. So I'll have those episodes coming out this weekend, as well as more episodes coming out Monday, Tuesday, Wednesday, Thursday next week. And then again, be back here next week for another live stream. But I hope everyone has a wonderful weekend. Hope everybody enjoyed the content tonight, and I will be back, and I'll see everybody real soon. So have an awesome weekend. See everybody again next week.